In this video, we're going to go over a balance sheet example and explain the different parts of the balance sheet. This is another video from accounting101.org. You can visit our site for more accounting videos, tutorials, and explanations like this at accounting101.org. So, the balance sheet. So we're looking at the balance sheet from Scammer Corporation, and at the top you see that it says Scammer Corporation balance sheet December 31st, 2011. So we'll start our explanation right there. Notice that it just says December 31st, 2011. It doesn't say for the period ending December 31st, 2011. And that's because the balance sheet is basically a snapshot in time. Really, you could make a balance sheet every single day of the year, and what it does is just shows you at that point in time what the assets of the company are, what the liabilities are, and what the stockholders' equity are. And it just gives you basically a picture of how the company's doing financially, what they own, what they owe, and who owns what, basically. Now, the first things that you should notice is that here on the left side of the balance sheet we have the assets, and on the right side we have the liabilities, and we have stockholders' equity. Those are the three main parts of any balance sheet, and the accounting equation is assets equals liabilities plus owner's equity or stockholders' equity. So the balance sheet is always basically divided right in half, and on the left side you'll have the assets, and on the right side you'll have both the liabilities and the stockholders' equity. So to kind of understand why that is, the assets is what the company owns. It's stuff like their cash, the accounts receivable, inventory, prepaid insurance, land, buildings, equipment. It's their resources, things that they have to use that will bring some sort of gain or profit or benefit, economic benefit, at some time in the future. That's what an asset is. A liability, well, really the right side of the balance sheet here is basically explaining how the assets were paid for. So the liabilities, account for a certain portion of the assets, and the stockholders' equity does the same thing. So if the company issued a bunch of stock right here to pay for, their inventory and their prepaid insurance and a piece of land, then that's what this number right here is representing, that the company issued stock, to pay for those portions of the assets, and so that's accounted for in the stockholders' equity. So let's say on the other hand that this company, Scammer Corporation, bought a computer so that they could scam people better, and that equipment that they purchased, they bought on account. So it would be accounted for over here in accounts payable. So the 4,000, 2,000, or I guess 2,100 of that is what they owe for purchasing this equipment that shows up in their investments, or I'm sorry, in their assets. So those are the two ways that the liabilities and the stockholders' equity account for what's in the assets portion of the balance sheet. Now, another thing to understand is that let's start with the assets. The assets are divided up into two sections. You have current assets, which are right here, and then you have long-term assets or fixed assets, which are usually right here, and I guess right here as well. Anything that's not a current asset is a long-term asset. So current assets are resources that are going to be used up within a year. So cash, accounts receivable, inventory, prepaid insurance, those are all going to be used up, or it's assumed that they're going to be used up within a year. Then you have property, plant, and equipment, intangible assets such as goodwill or patents. Those may or may not be amortized, but usually those are classified as long-term assets because the amortization, if they are amortized, will take longer than a year. So basically, the two sections are current assets, anything that will be used up within a year, and then anything that will be kept around or will be able to be used for longer than a year is a long-term asset. And so the same thing applies over here. You'll see that this says current liabilities. You have these things, which are accounts payable, wages payable, interest payable, taxes payable. These are your current liabilities, or obligations that need to be satisfied within a year. Then you have long-term liabilities. These are the liabilities that need to be, well, that don't need to be satisfied within a year, that can be put off longer, basically. And then, you add those two together, you have total liabilities. Now down in the stockholders' equity, usually it's the same type of accounts that you'll see over and over again. Whether it's called common stock, capital stock, there's preferred stock. We won't go into those different meanings here. There's retained earnings, and then you just have total stockholders' equity. So the total liabilities plus the total stockholders' equity will equal what the total assets equal. So the two sides of the balance sheet will always balance, as long as the financials have been done correctly. And that is a basic explanation of how the balance sheet works.